Supermicro Computer Inc., trading under the ticker symbol SMCI, is currently navigating a highly volatile session as of Wednesday, May 13, 2026. The market is currently closed, but the most recent activity is still being digested by investors who are reacting to a mix of legal headlines and financial resilience. The stock officially closed its last session at $32.79 per share, representing a decline of 2.18% during standard hours. In the after-hours session, however, we saw a slight attempt at a recovery, with the price taking up to approximately $32.40 as traders weighed the impact of a significant legal indictment against the company's impressive revenue figures. This movement reflects a broader tension in the tech sector, specifically among the hardware providers that fuel the ongoing expansion of data centers. While the surface-level story for Supermicro is often focused on its role in the liquid cooling market, the reality sitting just beneath the surface is a complex web of legal challenges and a massive buildup of inventory that hints at a high-stakes bet on the next generation of hardware. Expectations for SMCI have been sky-high since the start of the year, with many retail investors on platforms like Robinhood and SoFi Invest looking at the company as a pure-play bet on the hardware needs of the modern internet. The reality, however, has become much more nuanced as institutional activity via Interactive Brokers and Schwab Intelligent Portfolios shows a more cautious approach. Just days ago, a securities class action was filed against the company following an indictment involving an alleged server diversion scheme. This legal hurdle has created a curiosity loop for investors. How can a company reporting quarterly net sales of over $10 billion also be facing allegations of illegal shipments? The contrast is stark. On one hand, you have a business that saw quarterly net income rise to over $483 million, up from about $109 million just a year ago. On the other hand, the market is grappling with the revelation that insiders may have been routing restricted systems to foreign markets without proper licenses. This creates a psychological tension for any investor. Are you buying into a growth story that is fundamentally broken, or are you catching a massive discount on a company that has effectively become the backbone of the global server market? Looking at the daily swings and sector momentum, Supermicro is currently a high-beta name that moves significantly faster than its peers in the broader tech index. The trading volume has remained elevated, with unusual options activity often signaling that the big players are hedging their bets. For instance, recent data showed nearly 400,000 options contracts traded in a single day, with a heavy leaning towards call options despite the negative legal news. This suggests that while the headlines are grim, there is a segment of the market, often found using the Fidelity trading platform or advanced Interactive Brokers tools, that believes the long-term demand for high-performance servers will outweigh the short-term regulatory fallout. The sector as a whole is facing macroeconomic pressures, particularly around the cost of capital, but Supermicro's aggressive use of debt to fund its inventory buildup is a unique factor. The company ended its recent quarter with nearly $9 billion in total bank debt and convertible notes. This is a massive expansion from previous years and signifies that management is leaning into growth at a time when many other firms are trying to tighten their belts. Institutional activity is where the real story often hides. When you look at the holdings through a Fidelity brokerage account or a Schwab individual brokerage, you see that the smart players are closely watching the inventory levels, which have ballooned to $11.1 billion. This inventory isn't just a number on a balance sheet, it represents thousands of server racks waiting for the latest chips to be integrated. The market expects these racks to fly off the shelves, but the reality of supply chain bottlenecks could turn that inventory into a liability if demand cools even slightly. This brings us to a critical point for anyone watching this stock. Do you think the current legal challenges will fundamentally alter Supermicro's partnership with major chip designers, or is this just a temporary speed bump in a much larger expansion? Comment below how many shares of SMCI you currently hold, or if you are waiting for a lower entry point before putting your capital to work. Supermicro Computer Inc. functions primarily as a provider of high-performance server and storage solutions. Its business model is built around what it calls building block solutions, which allow for a high degree of customization for enterprise customers and cloud service providers. They were one of the first to market with direct liquid cooling solutions at scale, which is a necessity for the heat-intensive workloads required by modern software. This early lead gave them a moat, but that moat is being challenged by traditional giants who are now aggressively entering the space. Past performance shows a company that was able to pivot quickly, but the current scale of operations is entirely different from where they were even 2 years ago. The shift from a mid-cap server builder to a global infrastructure powerhouse has come with growing pains that are now manifesting in the form of audit concerns and legal scrutiny. The future outlook for the stock is a tug-of-war between two very different scenarios. In the bullish scenario, the company successfully navigates its legal hurdles, reaffirms its guidance for the full fiscal year, which targets revenue in the range of $39 billion to $40 billion, and continues to gain market share in the liquid-cooled rack space. In this scenario, the current price in the low 30s would look like a historical steal for those using self-investing strategies. However, the bearish scenario is one where the legal indictment leads to restricted access to key components or a loss of trust from major hyperscale customers. If those $11 billion in inventories cannot be moved because of regulatory restrictions, the debt load could become a crushing weight. The reality is likely somewhere in the middle, but the volatility will remain extreme as the market waits for more clarity on the DOJ findings. As we analyze the current state of Supermicro, the tension between the narrative of a growing infrastructure giant and the reality of a company under intense legal pressure defines the current investment thesis. For those using Robinhood stock trading or the Fidelity mobile app to manage their portfolios, the key is to look beyond the daily price action and focus on the fundamental conversion of inventory into cash.
The company's transformation into a total data center provider is moving fast, but the balance sheet complexity is increasing just as quickly. The contrast between the $10.2 billion in sales and the $6.6 billion in cash used in operations tells you everything you need to know about how capital-intensive this phase of growth is. Investors are currently being asked to fund a massive expansion while simultaneously ignoring a dark cloud of litigation. Whether the market chooses to focus on the record revenue or the alleged illegal server diversions will dictate where the stock moves in the coming weeks. To wrap this up, the central insight here is that Supermicro is no longer a simple hardware play. It is a highly leveraged bet on the continued build-out of global data centers. The expectations of a smooth climb have been shattered by reality, yet the underlying demand for the company's products remains robust. We've seen the stock fluctuate from its 52-week high in the 60s down to the low 20s, and this current range in the 30s represents a pivotal moment. If you are looking for investment help or exploring various investing sites, remember that a company with this much growth and this much risk requires a clear-eyed assessment of its balance sheet. The authority in this space is built on transparency, and until Supermicro provides a final 10K and resolves its auditor situation, the tension will remain the dominant force in its price action. Authority in the market is earned through consistent execution, and for SMCI, the next few months will determine if they can reclaim their status as a leader, or if they will remain a cautionary tale for those who ignored the warning signs on the balance sheet. Keep a close eye on the volume and institutional flows, as they will likely signal the next major move before the retail crowd catches on.